Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about ECHOSTAR CORP quarterly report. ECHOSTAR Corporation offers a diverse range of businesses and services across 4 segments: pay TV, retail wireless, 5G network deployment, and broadband and satellite services. The company's pay TV segment provides direct broadcast and fixed satellite services, including receiver system design and distribution, digital broadcast operations, and streaming services under the Dish and Sling brand names. In addition to pay TV services, ECHOSTAR also offers retail wireless services through its Boost Mobile, Boost Postpaid, and Gen Mobile brands, as well as various wireless devices. The company's 5G network deployment segment focuses on deploying a facilities-based 5G broadband network and commercializing the deployment of 5G VoNR, Voice over New Radio. ECHOSTAR's broadband and satellite services segment offers broadband services to consumer customers, including home and small to medium-sized businesses, as well as satellite and multi-transport technologies, and managed network services to various enterprise customers. The company's services can be summarized into the following key areas: pay TV services, retail wireless services, 5G network deployment, broadband services for consumers and businesses, satellite and multi-transport technologies, managed network services for enterprises. The skyrocketing stock price of ECHOSTAR Corp. A year of transformation. ECHOSTAR Corporation's stock price has experienced a remarkable surge in the past year, rising by over 171% and 202.76% respectively. Several key events have contributed to this significant increase. The sale of wireless spectrum assets to AT&T for $23 billion was a major catalyst, addressing financial challenges and regulatory risks. Additionally, the sale of AWS-3 spectrum to SpaceX for $2.6 billion in stock helped resolve FCC disputes regarding spectrum utilization. The resolution of these disputes led to the FCC confirming that ECHOSTAR had met 5G network build-out requirements, significantly improving the company's stability perception. The formation of ECHOSTAR Capital and leadership changes further solidified the company's future growth prospects. A strategic partnership for a LEO satellite constellation with MDA was also announced, aiming to meet growing demand for 5G connectivity. These transformative events have collectively contributed to ECHOSTAR Corp's skyrocketing stock price in the past year, positioning the company for continued growth and success. The primary drivers of revenue growth or decline are multifaceted. On the growth side, key factors include an 8.5% increase in gross new wireless subscribers, higher marketing expenditures, and a shift in subscriber plan mix to higher-priced service plans. Additionally, growth in digital channels, increased sales of value-added services, and asset sales contributed to revenue growth. On the decline side, significant factors include a 9.2% decrease in service revenue due to lower broadband sales to consumers and enterprises, as well as equipment sales and other revenue declines. The transition from a 5G network to a hybrid MNO business model also impacted revenue growth, while investment in wireless spectrum licenses further reduced revenue. Overall, the interplay between these factors has resulted in a complex revenue landscape, with both growth and decline drivers at play. Net income and profit margins decline. Key factors: the net income and profit margins of the company have experienced significant declines from Q3 2024 to Q3 2025. Net income decreased by $12,781,348 in Q3 2025, compared to -$143,801 in Q3 2024, a staggering drop of over $13 million. The year-to-date net income also saw a substantial decline, decreasing by $16,641,875 from 2024 to 2025. Profit margins have been severely impacted as well. Operating income margin plummeted from -4.1% in Q3 2024 to -461.6% in Q3 2025, while net income margin decreased from -3.7% to -353.8%. The OIBDA margin also turned negative, dropping by $16,653,884. Several factors contributed to these declines. Impairments and other expenses increased, while operating income before depreciation and amortization, OIBDA, decreased. depreciation and amortization expenses rose, and the loss of ACP subscribers with lower average revenue per user, ARPU, further exacerbated the issue. The termination of the 5G network and transition to a hybrid MNO business model also played a significant role in these declines. The company's financial performance indicates a consistent trend of generating positive operating cash flow. In both 2024 and 2025, the net cash flows from operating activities were substantial, totaling $1,207,144 and $325,948 respectively. This demonstrates the company's ability to generate sufficient cash from its core operations to meet its financial obligations. Furthermore, management expects to rely on this positive operating cash flow to fund future working capital requirements, capital expenditures, other investments, and debt service needs. The company's debt level and interest expenses have undergone significant changes. The current portion of debt has increased from $943,029 to $4,519,619, while long-term debt has decreased from $25,660,288 to $21,791,251. Interest expense has also seen a substantial increase, rising by $295,569 in the 3-month period and $680,282 in the 9-month period. Furthermore, cash paid for interest has increased from $895 million to $1.23 billion. These changes indicate a notable escalation in the company's debt level and interest expenses. The company's financial performance was mixed across various segments and regions. The pay TV segment struggled significantly, with a -10,600% decrease in revenue and a substantial operating loss. The wireless segment initially performed poorly due to its dependence on other networks, but later showed improvement with a 45% increase in revenue. In contrast, the broadband and satellite services segment demonstrated resilience, with an adjusted OIBDA of $74,527. At the consolidated level, the company's adjusted OIBDA reached $230,884. These results indicate that while some segments faced significant challenges, others were able to adapt and perform well. Management's outlook on company strategy. The company's management has outlined several key strategies and outlooks for the future. One of the primary goals is to transition to a hybrid MNO business model, which will allow the company to continue operating its 5G network core while utilizing AT&T's network services. This transition is expected to be completed by December 31, 2031. To achieve this goal, management plans to invest over $1 billion in wireless spectrum licenses and has entered into transactions with AT&T and SpaceX to sell a material amount of spectrum licenses. The company also expects to meet data thresholds in 2025, which will trigger reduced rates under the Sixth Amendment to the Network Services Agreement. In addition to these efforts, management is looking to expand target segments and profitably grow the wireless subscriber base by acquiring and retaining high-quality subscribers with competitive offers, choice, and outstanding customer service. The company also anticipates a decrease in operating expenditures as the 5G network is completed and transitioned to the hybrid MNO network. Overall, management's strategy focuses on expanding the company's business through strategic investments and partnerships while reducing costs and improving efficiency. Acquisitions and divestitures overview. The company has made significant acquisitions and divestitures in recent years. On the acquisition front, 2 major transactions stand out: the AT&T transactions and the SpaceX transactions. These deals have likely had a substantial impact on the company's operations and financials. In terms of divestitures, the company has disposed of certain assets without providing specific details. Additionally, it has sold a material amount of spectrum licenses to both AT&T and SpaceX. The company has demonstrated its commitment to returning value to shareholders through 2 key initiatives. Firstly, it has been allowed to pay dividends, albeit with certain restrictions in place. Secondly, the company has authorized a share buyback program worth $1 billion, set to expire on December 31, 2026. These actions indicate that the company is actively engaged in rewarding its shareholders through both cash and equity-based means. Concerns about inventory buildup or supply chain disruption. the financial summary highlights several concerns regarding the potential disruption of supply chains. Changes in trade policies, including tariffs and restrictions, are identified as a major risk factor. These changes can lead to customs delays, higher costs for wireless devices and equipment, and ultimately disrupt supply chains. Furthermore, there is a potential for inventory buildup if companies are unable to pass on increased costs to their customers. This could have significant implications for businesses, making it essential to address these concerns proactively to mitigate any potential disruptions. That concludes the financial summary for ECHOSTAR CORP. Feel free to comment below, and I will be happy to answer them when possible.